this is Tom Cloud with a special end of third quarter financial report for FTM. We're going to start by acknowledging we're in a recession. The figures came out for the end of the third quarter on Friday, and it's negative 1.4% after 1.6% the second quarter of 2022. So we are in a recession. They can't anymore tell you that we're not. And we're seeing big contractions in these markets. I start out with a report card, as we do every quarter, and look at where we stand now with the investment categories that we follow. For 2022, the Dow is down 21% for the first 3 months, first 3 quarters of 2022, with 1 quarter to go. We're seeing everybody, seems like Ray Dalio, all the major people are saying there's going to be at least another 15 to 20% drop between now and March, and even maybe this calendar year, 2022. So if the Dow drops another 17%, it would reach where it did back in 2008 and 9 during the last real bad recession. So you've got to be careful about investing in the stock market, and we'll get to that as we get toward the bottom. The NASDAQ did even worse. It went down 33%, not 21 like the Dow, 33% so far this year, and expected to go down at least 50% for the year. And just think how many years it's going to take to recover. You don't need to just sit there and watch it. You still have time to make adjustments and save yourself money, in my opinion. The S&P 500, it's down 25% for the first 3 quarters, and expected to go down at least 40% total, or another 15% as we head toward the last 3 months of the year. So quick review, the Dow's down 21, 33 for NASDAQ, 25 for the S&P. Now, the metals are also down. Gold is down 8.75. And just like we saw back in 2008 and 9, gold is the best investment by far. It's where you need to be loading up, and we're going to get to that. I don't know any place to get a higher allocation than gold. There's not a place on earth. You need to reallocate and increase your gold holdings, and we'll get to that in a minute. Bloomberg Total Return Fund down 21% for bonds, and expected to continue because the Fed will probably raise rates at least one more time, or at least 75 basis points, as they go after inflation, trying to stop it. And inflation only went down 0.1%. It's still 8.3%, and a possibility of it being much higher. So we'll be watching the Fed closely, and if they do go down up 0.75%, it's going to devastate what is already a falling, collapsing real estate market after the biggest 2 years in history in an up market. But on Friday, we saw mortgage rates right at 7%, a 21-year high. I mean, interest rates are flying up all over, not just the Fed rates, interest rates on the debt. Just think that the debt that we have of $31 trillion that we have on a budget deficit. The interest rate's gone up 1%, that's $300 billion a year for a 1% increase in the interest rate. And people, you can't do that. I mean, we've got a currency that is way overvalued because of everything else going on in the world. It's a safe place to park your money. But the dollar is in a no-win situation. It will collapse, and it will go down dramatically, and those that are holding dollar-denominated assets will lose a tremendous amount of their portfolio. The difference this time is it's not coming back like it did before. It's going to take years to get back in real estate. Like I said, it's going to take years to come back. The longer the rates stay around 7%, the less people qualify to buy the size house and price house that they would really like to have, but they can't. But the biggest problem we have out there is unfunded liabilities. All these, when we have awful catastrophe like we have going on with Ian, we have to print the money. We have to answer. We have to call it a disaster, which I don't have a problem with. The problem is, though, you just print it and there's nothing to back it. It's an unfunded liability. And it just piles up, and we just keep going worse and worse. Going back to the dollar index, one point, I just looked at my notes. The dollar is down 15, it's up 15.3%. Gold is down 8.75. This is great because the last 3 months, as the dollar's continued, every 1%, the dollar goes up, gold goes down 1. So now it's cutting in half, where we think the dollar will go up 3% for every 1%. The dollar will go up starting right now. The dollar should be turning and headed lower. And once again, we expect gold to go up 3% for every 1% that the dollar goes down, because it's at 112 on the index. We think it'll go back to 95 where it was in March. And if we get that, we're going to see gold move somewhere in the neighborhood of 40%, which would put it back at its high in March around 2,000 an ounce. And right now the spot price is around $1,660. So just think, it's already been $2,000 this year, and now it's at $1,660. What a gift it is. It's gone down $400 an ounce. If you don't think it's ever going back to 2,000, don't buy it. But I guarantee you, I've loaded up. I've never seen, we've had 4 of the biggest months back to back to back to back we've ever had. And it's people reallocating and moving money into what makes sense, that is money. We've talked about Basel III and the central banks buying money. We see central banks like Credit Suisse in financial trouble. We see all this coming to a head. It's going to be awful for the banks. FDIC has a very small percentage assets to cover what they've got insured in your bank accounts. Remember, the next bank crisis, there'll be a bail-in, because the G7, they already own your deposits. The liability is they owe it to you. But the reality is, if there is a crash or a currency change, they're going to use your money to come out. And then the 401ks, you look at the largest pool of money, we see write-ups that Biden's administration wants to do something about making you put your money into U.S. Treasuries to where they don't go bankrupt and our credit's worth nothing. But all this stuff is out there. But all of it's bad. I mean, there's really not great economic news out there. It's just hard to believe. And gold is flying up in Japan and England because, once again, they're coming down. I mean, their value is coming down against the dollar. So they're up 13, 15% this year buying gold by dumping their Japanese yen and British sterling. They're making 15% in their world. We're over here with gold down 8%. But once again, we think that is very close to turning and going the other way. So today's was to talk about gold, talk about the economic indicators, and looking at the end of the third quarter, our performance. And once again, we expect that to continue in a downtrend. I really appreciate the calls I've had about diversified confidence. We've been over it 2 times in a row, but let me hit it one more time for those that haven't heard it. Diversified confidence. Don't put money anywhere that you don't have confidence in. Don't just sit it in stocks and watch it go down if you think it's going to go down 15 or 20%, where Ray Dalio, the biggest manager in the world, is saying, get out and get in gold. So look at it, and that's one thing. The bond market interest rates are going to keep going up. The Fed's going to hike rates at least 0.75% in my opinion. Why would you move into bonds when the diversified confidence is low by doing that? So if you diversify to gold, you know what I think, and a lot of you think, is that's where you want to build up because you have confidence that the dollar is going down and the stocks are going down and bonds are going down. So you want to take a bigger allocation into gold. You look at real estate, and up until the last 3 weeks when we've had the new interest rate hike, it was a good place to allocate money. You may still use some mutual funds to take some dividend paying real estate stocks in there. But there you talk to your financial advisor about that. But you've got to have diversified confidence to put money somewhere. That is my story, and I'm sticking to it. And let me say, if you haven't got a self-directed IRA and you're coming out and retiring and you have a 401k, you should immediately set up a precious metals IRA and a stock and bond IRA for the time that you want to re-enter. But I'd advise you strongly to call our office and talk to Dan Scoggins, who's done that for me for years. And Dan can be reached at 800-247-2812. 800-247-2812, and get you 2 IRAs or set up another one and move part of a current IRA to put over there. Dan will direct you on the custodians that are available, and I think it'll be tremendous. Lastly, if you haven't talked to me about diamonds and you haven't looked at the video we sent out, or if you didn't get the video we sent out, also let Dan know in our office and we'll resend it. But this place is going to be a great place to have money in this new product of icecap.diamonds. Please look at their website at icecap.diamonds. Give me a call Dan or Catherine at the office, and they'll get a message to me, and I'll call you back. But time's running out on that too, because it's getting more accepted in the world market, and will continue to grow, we think, quite a bit the next year to 5 years. And remember, diamonds are now liquid for the first time ever, and you can enter at very low markups. So we're real excited because diamonds, like nothing else, are confidential, portable. You can hold over $1 million in the palm of your hand. You can take it in your pocket through a detection device. But people are moving toward having that extra 2 or 3%, 5% of their assets in these diamonds. We've been very successful with this, and if you haven't got into it, I would urge you to look at it closer. So with a special report at the end of the third quarter, the opinions of where I think things are, 47 years of doing this, I've seen it. Last time I talked to you about how today looks just like 1977 to 80. It's a perfect overlay of what's going on in the Biden administration as to what was going on in the Carter administration back in that time frame. So anyway, until next time, this is Tom Cloud signing out with my special precious metals market update.